Barry, it was another month where markets moved to the tune of the Federal Reserve. Both June and July meetings saw 75 basis points hikes, and the rhetoric was similar. So why was June interpreted as hawkish and July dovish? And why is the Fed so impactful on markets?
Good question, Chloe. Well, I think to take the last question, we are obviously living in a very high inflation environment at the moment, where the range of outcomes is very wide. And what the Federal Reserve, as the world's most powerful central bank, does will be tremendously impactful on those range of outcomes. So that is why at the moment investing seems very macro driven rather than stock picking. And I think the Federal Reserve will continue to have a big impact on markets as they attempt to control inflation. Coming back to the two FOMC meetings, in June, if you remember, Powell very much emphasized the unconditional nature of the Fed's fight against inflation. And to that regard, the markets interpreted that as the fact that they would be less sympathetic to what happens with the economy, and they'd be willing to tolerate a fairly deep and painful recession, which might bring inflation back under control, similar to that the US experienced in 1981 with Paul Volcker. I think whether this was intentional or not, there were a couple of things in the July FOMC meeting which the markets interpreted as more dovish, namely the fact that the statement started to talk about macro leading indicators and also said that the Fed still hoped to achieve a soft landing. In other words, fighting inflation seemed to be conditional on a soft landing and not unconditional anymore. And I think the other part was that the Fed also repeated their view that 2.5% was a neutral rate, where the FOMC had obviously hiked rates by 75 basis points in July to get to, and only a moderate restrictive monetary policy was needed to tame inflation. So moderately restrictive means that maybe one or two more hikes from 2.5%, but certainly no more, and certainly no positive real interest rates. So I think the Fed has tried to walk back the market's interpretation of this dovishness, but the markets are now calling their bluff.
How does your view on inflation differ from consensus?
Well, we essentially believe that inflation is more structural for reasons that we outlined in our stockumentary on the 1970s redux. So it's got to do with deglobalization, decarbonization, as well as the excessive money printing of recent years. I think the market thinks that inflation is only high because of the aftermath of COVID and because of the Russia-Ukraine war. So that's the debate, if you like. If you think that inflation is still largely transitory, then interest rates don't have to go up much further. It's just a matter of time before the economy readjusts. If you think it's more structural, like we do, then you have a much bigger problem, which can only be solved by the supply side and higher for longer interest rates. So I think the market is now trying to front run peak hawkishness. In other words, they're trying to get ahead of central banks turning less hawkish and more dovish. And that's on the basis that they think that inflation has peaked and will quickly fall to the sort of 2% official target level that most central banks have. I think that that's largely based on recent falls in commodity prices that we saw in June. And those commodity price falls, in my view, were almost solely down to the fact that the market was worried about Fed hikes. So it's curious that the deflationists think that we're going to have a soft landing and not very many more interest rate hikes, but somehow commodity prices are going to stay down where in our opinion, it was the fear of the hard landing and the rate hikes which caused commodities to sell off in the first place. And they're also focused on this glut of retail inventory, which is, if you like, a hangover from COVID. And I think that's more convincing. But I think one of the problems that the deflationists have is a lack of understanding of what makes up the CPI print. So around 2/3 of CPI is basically service sector inflation, of which about a third is rental inflation and a third is labor. And rental inflation is significantly lagging house price appreciation, so that will continue to go up. And the labor market wage inflation is really pretty sticky. And in the lessons of the last few decades is that if you want to actually solve wage inflation, you actually have to have some unemployment. This was called the trade-off of the Phillips curve, where there was this trade-off between unemployment and inflation, and therefore unemployment, which is still near or at a record low in the US, will have to go a lot higher from here in order for wage inflation to come down. So we've said all along that inflation is structural, and the Federal Reserve have this choice, either to try and kill inflation in the short term, but probably not the long term, by a deep and painful recession, or they can aim for a soft landing, which will be less painful for the economy, but won't kill inflation and will result in structurally high inflation. So I think this emphasis on the soft landing, which was again reintroduced into the July FOMC, and thinking that inflation could be tamed with only a moderately restrictive monetary policy, has, if you like, unwittingly opened the window on risk assets again. For the deflationists, it of course means that we're near the peak of interest rates, and therefore we're back to the same bull market in long duration assets as we saw previously. And for people like me that think we're in a commodities bull market, it is of course also bullish for commodities in the short term. And all of this, I think, is sadly what Arthur Burns in the 70s, the Fed governor in the 70s, was criticized for, in that these sort of stop-start cycles, and also just easing monetary policy into elections. And specifically, obviously, we have the midterm elections coming up in November in the US itself. So we think that the Fed will regret its perceived dovishness at the last FOMC, and will obviously have to try to correct the market, and that will involve higher interest rates. But for the moment, I think the bulls are certainly in charge of the narrative.
Why is there confusion about whether the US economy is in recession, and what are the implications for investors?
Well, the definition of a recession has and will always be 2 consecutive quarters of negative real GDP. So that the US is definitely in a recession. But it's no ordinary recession. In fact, it's a nominal boom, in that because of inflation running at 9%, 1% negative GDP growth translates at 8% growth in the nominal economy. And of course, most of us live in the nominal economy, where wages are nominal, corporate profits are nominal. So this is why you can have a recession, but no big fall in corporate profits. In fact, corporate profits can continue to rise, and no fall in wages or unemployment either. And this, I think, is something that is still very poorly misunderstood, and actually very poorly communicated by central banks, the difference between nominal growth and real growth. And we are in a nominal boom. And in order to get inflation obviously down, what would normally happen is that in a recession, nominal growth would go below real growth. And therefore, you can sort of come to the conclusion that you'll have to have a much deeper recession, i.e. a much more painful recession than just -1, to get inflation or nominal growth down. I think the market is obviously one of the bullish things I think about what the market has observed over the last couple of weeks is that corporate profits are still generally good because corporates are living in this nominal world. And therefore, the markets have generally been pretty infused about this nominal growth. But I think there's an element of cakery about this because the markets haven't realized that in a nominal boom, all of that growth is fake because it's all inflation. And what we saw in the 70s was that people will refuse to pay high valuations for fake nominal growth. In other words, a nominal growth and stagflation is okay for corporate profits, but it results in much lower valuations. And the reason for this is the inflation rate becomes the discount rate. If inflation's running at 10%, your pound in your pocket is only going to be worth 91p next year. So you put a much higher discount rate on future profits. And that's why markets derate in an inflationary environment where corporate profits are driven by nominal but not real growth. And it's also worth noting for all of those who deny that we're in a recession, that nominal growth throughout the 1970s in the US never fell below 5%. So by that definition that recessions have to be nominal, the US didn't experience any recessions in the 1970s, which we know of obviously isn't true. So we're in a nominal boom, but we're in a real recession.
Markets unexpectedly had their best month of the year, but the fund delivered an uncorrelated negative return. Why was this?
So the negative return was caused by the short book, the same short book which has delivered the positive returns year to date. And what we saw was that the stocks that had fallen the most year to date, often with the worst fundamentals, were the ones that rallied the most during the month. And this kind of dash for trash normally occurs with a big easing of global financial conditions. And of course, that went against the fact that we saw a second 75 basis point hike by the Fed in the first rate rise from the ECB in nearly a decade. But the markets were obviously anticipating peak hawkishness and want to try and front run central banks. Now, of course, we think the idea that inflation has peaked and is going to come down quickly, given our view on the structural nature of inflation, is frankly for the birds. And that central banks will push back on this anticipated dovishness. But I think, at the moment, we've certainly, been prepared to be pragmatic. This market move seems to have some momentum behind it, which is, I think, owing to very cautious positioning in general. And so we cut back our short book to just 40% of NAV, and we're really waiting for the, if you like, the inflation penny to drop.
Can you give us an update on commodities and the fund's current exposure?
So commodity prices obviously sold off in June because the market was worried about this very aggressive hawkishness from the Federal Reserve. But the fundamentals for most commodities, particularly in energy and agriculture, remain very strong indeed. So if the market is obviously less worried now about interest rate hikes in the short term, that should obviously be good for commodities. And since the Fed meeting, most commodity prices have gone back up again. So that will present obviously a challenge to those that think that commodity prices coming down is going to be the end of inflation. So we think that commodity prices and commodity equities should bounce back. And one of the other things I'd point out is that though it's generally perceived that the Ukraine-Russia war has been bullish for commodities, Russian oil exports are actually at a record high. They've not come down at all. And in fact, Europe has yet to start weaning itself off Russian energy. And the first proper ban of Russian coal, if you like, starts in August. There's no ban on Russian oil, and obviously Europe's still desperate for Russian gas, and to a lesser extent, Russian refined product. So if the European Union follows through on some of these bans on Russian energy, which I'm skeptical of, we will see much tighter energy markets over the next few months. And in particular, we've got to consider that the SPR release of oil in the US, which is 1 million barrels a day, that will come to an end too. So I don't think you can have a soft landing without commodity prices going up. So that's if you like, where we're happy to still be bullish, both for longer term supply reasons, but also if we're having a softer landing and this nominal boom will continue, then commodities will also hold up surprisingly well.
How long can the current beta rally last?
Well, I think it all depends on your view of inflation. If you think that inflation is still largely transitory, that it's caused by COVID and the Russian-Ukraine war, which is, I think, what the Fed still thinks, given they think the neutral rate is 2.5%, and I think it's largely what equity markets and bond markets think, then the rally could go on and it could be the start of a new bull market. And one can see the logic that if inflation is going to come down, interest rates come down, that's going to be bullish both for the economy, but also for asset prices. But frankly, we think that's for the birds, Chloe. That inflation is structural, that the Fed and the market is simply looking at this Goldilocks period of the last 20 or 30 years and thinking that we'll go back to that. And they haven't considered what has changed in terms of deglobalization, decarbonization, and living with the hangover from the money printing. So we're obviously prepared to be pragmatic in the short term, but I think, you know, when inflation prints continue to be stickier than the market has anticipated, and for example, you know, it seems to be like a record playing over and over again, that every time you see a high inflation print, all the deflationists say, oh, it's the last high print and it's going to go down from here. Well, I think we're going to get a few more high prints, particularly obviously given the stickiness of service inflation, but also that commodities will probably start to go back up in a soft landing. And I think at that point, the bond market starts to back up again and yields for the 10-year start to go over 3% again. And then we have the same mini cycle over it again, where the Fed has to get hawkish and valuations go down and the market flees risk assets. But for now, we're happy to wait and watch and wait for the next inflation pin to drop.
Great. Thanks very much for your time, Barry.
Thanks, Chloe.